Hi everyone, I am going to start our discussion of the last paper CL2. This was the paper in July 2021 exam. So, it is my pleasure and honor to be your resource person to discuss the paper fully. And let me start with section 1, question number 1. So, there are 10 MCQs. Given below are certain duties and responsibilities discussed in the Code of Best Practice on Corporate Governance: approving the remunerations of external auditor, developing policies on obtaining non-audit services from the external auditor, assuring the confidentiality of whistleblowing employees, evaluating the performance of the Chief Executive Officer and key management personnel, reviewing the company's quarterly financial statements. Which of the above are duties and responsibilities of the audit committee per the Code of Best Practice on Corporate Governance? So, this is straightforward questions. If you have the corporate governance book, you can go to the relevant page and there you can see the list of duties of the audit committee, and then by looking at the list of duties given there, you can straight away find the answer. But if you take one by one, approving the remuneration of the external auditor, yes, it is a part of the duty of the audit committee. And developing policies on obtaining non-audit services from the external auditors, it has also been part of the duties and the responsibilities of the audit committee. Assuring the confidentiality of whistleblowing employees, that is also part of the duties and responsibilities of the audit committee. Evaluating the performance of the Chief Executive Officer and key management personnel, so that the audit committee has got nothing to do with that. If you go through the list of duties and responsibilities of the audit committee, and this is not included. Reviewing the company's quarterly financial statement, yes. So, which of the above are duties and responsibilities of the audit committee per the Code of Best Practice on Corporate Governance? So, then the first one has to be included, second one has to be included, third one has to be included, and the fifth one has to be included. So, accordingly, it has to be C. The answer has to be C. Question number 1, 1.1, the correct answer has to be C. Which of the following statements is accurate in relation to the disciplinary procedures laid down in the list in the Act of Incorporations of the Institute of Chartered Accountants of Sri Lanka? The disciplinary committee may disenroll any member if satisfied that he or she is unfit to practice as a result of professional misconduct. B. A disciplinary committee has no power to administer oaths or affirmations to all persons who are required to give evidence before such committee. C. Any question before a disciplinary committee is determined by the decision of the majority of the members of the committee. The council appoints 5 persons from its members to constitute the disciplinary committee. So, the correct answer has to be C. So, there is nothing to explain there. It is just that you need to be aware of it, and if you just go through the study text, everything is clearly mentioned there. So, you need to just remember a few points, and the correct answer has to be C. Any question before a disciplinary committee is determined by the decisions of the majority of the members of the committee. (1.3) The following details relate to 3 companies registered under the Companies Act number 7 of 2007, Company A, Company B and Company C. Annual turnover rupees million, Company A, Company B, Company C, the figures are given. A total number of employees given, type of company, Company A Public Limited Company PLC, Company B Limited, Company C Private Limited. Major shareholders, Amarasena holds 65% of the voting shares. The Samaranayaka brothers cumulatively hold 52% of the voting shares, and company C, company A holds 55% of the voting shares. So, based on the information given above, which of the companies are required to submit annual audited financial statements to the Sri Lanka Accounting and Standard Monitoring Board? So, company A has to anyhow, it is a PLC and becomes a specified business entity, and company B, based on the annual turnover, also has to be a specified business entity. So, company C does not qualify to be a specified business entity. So, basically it has to be company A and company B. So, the correct answer, let us see, company A and company B, the correct answer has to be B. So, 1.3, the correct answer has to be B, company A and company B. The 1.4, Rotex PLC holds a 25% ownership stake in Matrix Private Limited. Matrix Pereira is a director in both the companies. Each week he works 3 days for Rotex and 2 days for Matrix. Both the companies have entered into separate contracts with Pereira and pay him a salary for the services provided. As a practice, Rotex pays the due salaries of both companies to Pereira each month. Matrix subsequently reimburses Rotex for the amount incurred on its behalf. Furthermore, Anna, Pereira's wife, serves as a director of Matrix. Based on the given information, which of the following statements is correct per LKS 24 related party disclosures? Only Pereira is a related party to both Rotex and Matrix. B. Pereira and Anna are related parties to both Rotex and Matrix. C. Rotex should disclose the remuneration paid to Pereira in relation to both companies under short-term employee benefits to key management personnel. D. Pereira is a related party to both the companies and Anna is a related party to Matrix. Now, we need to discuss something there. So, it is from LKS 24 related party disclosures, and let us study the scenario given. Rotex PLC, Rotex holds a 25% ownership stake in Matrix. Matrix 25%. Pereira is a director in both the companies. Pereira is a director in both companies. Director. Each week he works 3 days for Rotex and 2 days for Matrix. Both the companies have entered into a separate contracts with Pereira and pay him a salary for the services he provided. As a practice, Rotex pays the due salaries of both companies, right? So, Rotex pays the total salaries of Rotex and Matrix, so once and for all, and what subsequently happen is Matrix subsequently reimburses Rotex for the amount incurred on its behalf, right? So, Rotex pays the full amount and then they will reimburse it from Matrix, and that is a different internal matter. And then it also says that Anna Pereira's wife serves as a director of Matrix, right? Mrs. Pereira works as a director of Matrix. Now, what do they want us to do? Based on the given information, which of the following statements is correct per LKS 20 related party disclosures? Only Pereira is a related party to both Rotex and Matrix. So, that is wrong. Why? Now, already Mrs. Pereira, Anna, who is the wife of Pereira, has been a director of Matrix. So then only Pereira is a related party to both Rotex and Matrix. Now Pereira is a related party for both companies, true enough. But Anna, you cannot forget about Mrs. Pereira, Anna. And she also has to be a related party of Matrix at least, because the members of the key management should be related parties. Now Anna, the wife of Mr. Pereira, has been a member of the key management of Matrix. So why you cannot forget about it, and then you need to think, okay, Mr. Pereira has to be a related party of both companies of Matrix and Rotex. Apart from that, for the moment, apparently, now we need to study in detail. Apparently, Mrs. Pereira, Anna, has to be a related party of Matrix, and there is no doubt about it. Pereira, and so the first statement is wrong. Pereira and Anna are related parties to both Rotex and Matrix. We will study that. Anyway, Pereira has to be a related party of Rotex and Matrix. There is no doubt about it, because the question explicitly says that Pereira works as a director of both companies Rotex and Matrix, and there is no doubt about it. Then Anna, wife of Mr. Pereira, Mrs. Pereira, is a director of Matrix and has to be a related party of Matrix, and there is no doubt about it. But then we have another issue. What is it? We have learnt it in LKS 24 that the close family members of the members in the key management, close family members of the key management should also be considered to be related parties. Now, Pereira is a member of the key management of Rotex, and Mrs. Pereira, that is Anna, is a close family member of Pereira. So then, applying that criteria, Mrs. Pereira can be considered to be also a related party of Rotex. Now, Mrs. Pereira, Mr. Pereira, both of them are related parties of both companies of Matrix and Rotex. So, statement B should be correct. But let us see the remaining two statements as well. Rotex should disclose the remuneration paid to Pereira, okay, in relation to both companies, and that there is no requirement, because Rotex does not pay anything for company Matrix, and Rotex makes the payment on their behalf, but subsequently Rotex reimburses it from Matrix. So Rotex need not to disclose anything about anyone else's related party transactions. So that is wrong. D, Pereira is a related party to both the companies, and Anna is a related party to Matrix, and that is once again wrong. So I have proven already that Mrs. Pereira is a director for not only Matrix, also for Rotex. So the correct answer has to be B. 1.5. Which of the following is a disclosure of SLFR's 2 share-based payment arrangements that is modified during the year? The real value granted as a result of those modifications, non-vested share appreciation rights, description about those modifications, vested share appreciation rights. Now, your exam is an open book exam. You are permitted to take your required permitted publications to the exam hall, and you can straight away go to SLFRS 2 and see the disclosures under modifications. So the correct one has to be C. It's not hard and you need not to by heart. Straight away you can go to the relevant section, disclosure under modifications. You need to disclose description about those modifications. The correct answer has to be C. Which of the following covers sustainability reporting? SLFRS 16, SLFRS 15, LKS 36, no accounting standard specifically covers it. So we have learnt it that sustainability does not come from any of the accounting standards, no. So there is a separate framework for sustainability reporting, and it is not from an accounting standard, it is not from an SLFRS. So the correct answer has to be D. No accounting standard specifically covers it. 1.7, a company entered into a contract to lease a building with a lessor for 4 years. The following details are provided to you. Amount paid at the commencement of the lease is 50,000. The present value of the future lease payments which are discounted at the interest rate implicit in the lease and the above amount paid at the commencement of the lease equal to 6,771,200. Lease incentive received 10,000 rupees. Direct cost incurred by the company in connection with the lease is 40,000. So what is the initial measurement of the right of use asset per SLFR 16 lease? Now you can't come to straightforward answer at once. You need to do a small calculations and then only you can decide what the value of ROU asset should be. So let me work it out and let's see what the figure has to be. Now the lease liability or the present values of the future lease payments has been given 6,771,200. So apart from that, already right at the beginning, at the inception of the lease, we have paid another 50,000 rupees. You need to add it as well in arriving at the ROU asset. It is as per SLFRS 16. Lease incentives received. If incentives have been received, you need to deduct it. So let's deduct 10,000 rupees lease incentive. Direct cost incurred by the company in connection with the lease, 40,000, that has to be added. It has to be added. So let's take the total. 6,771,200 plus 50,000 minus 10,000 plus 40,000. So it's going to be 6,771,200 plus 50,000. Amount paid at the commencement of the lease 50,000. The present value of the future lease payments which are discounted at the interest rate implicit in the lease and the above amount paid at the commencement of the lease. I forgot it now. This 50,000 need not to be added because it's already included in the present value total of 6,771,200. And incentive figure has to be deducted 10. Direct cost has to be added back and it's 40,000. So then 6,771,200 minus 10,000 plus 40,000, it's going to be 6,801,200. So this is what the right of use asset value has to be at its initial measurement. So the correct answer has to be 6,801,200. So it's answer B. Answer B. .8. So we are given some details in a tabulated form. Segment X, segment Y, segment Z totals are given, segment revenue given, internal external given, total segment profit or loss, segment assets and segment liabilities. Which of the above segments are reportable segments per SLFRS 8 operating segments? Now to identify, to decide reportable segments, you need to apply the quantitative threshold of SLFRS 8 and you need not to make sure that all the quantitative thresholds are satisfied for an operating segment to become a reportable segment. At least one is enough. Now, SLFRS 8 says if the revenue of a particular segment, including the intersegmental revenue, is 10% or more of the combined revenue of all the segments, so that particular segment has to be a reportable segment. That is 10% threshold of revenue threshold. And if the profit or loss of a segment is 10% or more of the combined profit of the segments that reported only profits, if this the profit or loss of a particular segment is 10% or more of the higher of the absolute amounts of the profits of the segments that reported only profits and the total of the losses of the segments that reported only losses, then that particular segment can be considered to be reportable segments, that is profit or loss threshold in identifying reportable segments. The third one is where the assets of a particular segment is 10% or more of the total combined assets of all the segments of an entity, even that segment has to be a reportable segment. So, you need to do some calculations, you need not to do all the calculations of 10% revenue, 10% of profit or loss and 10% of assets. If you apply the 10% revenue and if a particular segment becomes a reportable segment as a result of satisfying 10% revenue thresholds, and you need not to check on the others. Now, in calculating 10%, you not only take external, also you are permitted to take internal revenue as well, and that is what SLFRS 8 says. So, let me first work out on segment A. At a glance, you can decide their revenue is apparently more than 10%, 345 divided by 839 into 100. It is 41%. It is a reportable segment. So, you need not to check on the others. You are wasting time. Please don't do that. Segment Y, apparently it is more than 10%. You can divide 420 divided by 839. So, it is going to be 50%. Segment Z, and that is what that deserves your attention, because you may have to sometimes check on all the quantitative thresholds. 74 divided by 839. So, does it become 10% or more? It does not. So, you need not to check on the 10% profit or loss and 10% assets for the other X and Y, because X and Y have already become reportable segments based on the revenue threshold. So, let me check on the revenue, check on revenue, profit and loss and assets for segment Z. Liabilities, you need not to check that. SLFRS 8 does not talk about liabilities. So, then they have a profit of 8,002 divided by 185,400. Remember, it is not 180,000. Wait, it has to be 185,400 plus 8,200. 185,400 plus 8,200. Take the total of the profits of the segments that made only profits and take the total of the losses of the segments that reported only losses, and then take the higher value. If you take the total of the profits of the segments that reported only profit seems to be higher. So, let me stick to that. 185,400 plus 8,002. What is the total? 185,400 plus 8,002. That is 193,600, 8,200. So, let us see the percentage, still 4.2, and then the total assets are 140,003 divided by 1561,900 into 100. It is still 9% approximately. So, segment Z does not qualify to be a reportable segment. Why? It does not satisfy any of the quantitative thresholds. So, the segments X and Y become reportable segments, and the answer has to be a segment X and segment Y, that is answer B. So, we are moving to 1.9. Consider the following information in relation to disclosure in financial statements. A maturity analysis for non-derivative financial liabilities. Number 2, a description of collateral held as security and other credit enhancements. Qualitative information about amounts arising from expected credit losses. Next one, a maturity analysis for derivative financial liabilities. Then fifth one, a description of how the entity manages liquidity risk. What is the question about? Which of the above information should be disclosed in financial statements in relation to liquidity risk per IFRS 7 financial instruments disclosures? A maturity analysis for non-derivative financial liabilities, yes, should be disclosed in relation to the liquidity risk. Then a description of collateral held as security and other credit enhancements. Now, you need not to disclose it. I mean, it's about the liquidity risk. A description of collateral held as security and other credit enhancements. A qualitative information about amounts arising from expected credit losses. Yes, you need to disclose it. Fourth, a maturity analysis for derivative financial liabilities, and you need not to disclose. A description of how the entity manages liquidity risk. Of course, you need to disclose it, that is in relation to liquidity risk. So, you need to disclose. First one has to be disclosed, third one has to be disclosed, and the fifth one has to be, I made a mistake, first one has to be disclosed. A maturity analysis for non-derivative financial assets, yes, should be disclosed. Then second one need not to be disclosed. A description of collateral need not. Then a qualitative information about amounts arising from expected credit loss need not, please, it need not. Fourth one, a maturity analysis for derivative financial liabilities, yes, need to be. A description of how the entity manages liquidity, yes, it has to be. So, the correct answer has to be B then, it has to be B. One point, this is question number 1, 10th item in the MCQ list. A company had the following transactions and balances denominated in foreign currency for the year ended 31st March 2021. On June 2020, sales of USD 5,000, of which 3,000 was received immediately, and the balance receivable on 31st March 2021. So, the receivable balance is another 2,000. Then on 1st April 2020, purchase of fixed assets amounting to $120,000 US, payable on 31st March 2021. 120,000 is payable. 120,000 is payable. On 1st April 2020, the exchange rate has been $190. On 31st March 2021, it is $196. So, we need to recognize an exchange difference of 6, and what is the question about what is the amount to be recognized as the difference, as the exchange difference in profit or loss for the year ended 31st March 2021. Then the sales occurred on 1st June 2020 when the rate was 186, and out of 5,003 has already been collected, another 2 is due, and that is receivable on 31st March 2021. So, the exchange difference has to be 10, So, 20,000 should be a credit to profit and loss exchange gain. 120 into 6, 720,000 should be a debit to profit and loss. So, then net amount has to be 700,000. You need to recognize it to profit and loss 700,000. So, the correct answer has to be A. So, that is the end of question number 1, and we are moving to question number 2. Section 2, question number 2. Mark Private Limited MPL applies SLFRS for SMEs in preparing financial statements, and its financial year ends on 31st March. The accountant of MPL has the following issues relating to the financial statements for the year ended 31st March 2021, which are yet to be resolved. On 31st March 2021, MPL was acquired by another company, a desk acquirer, and at the date of the said acquisition, the fair values of the assets and liabilities of MPL were estimated. Accordingly, MPL expects to recognize the following adjustments in its financial statements for the year ended 31st March 2021. A provision for a guarantee given by MPL to a bank for obtaining a loan by another party, and the acquirer has considered it as a liability having a fair value of 10 million rupees at the acquisition date as at 31st March 2021. The said party has made all the repayments of the bank loan and reflected a healthy financial position. A fair value gain from property, plant and equipment amounting to 170 million rupees, and the deferred tax impact thereon amounting to 40 million. An internally generated brand that has a fair value of 30 million rupees. The brand is considered to have an indefinite useful life. Second part, during the year, MPL issued preference shares amounting to 50 million rupees, redeemable after 5 years rather. According to the agreement entered into with the holder of these preference shares, the holder has the right to require MPL to redeem such shares after 3 years at the price mentioned in the agreement. The accountant is not sure about the accounting treatment to be adopted in these preference shares required. Explain the accounting treatment to be used for 1 and 2 above in the books of MPL for the year ended 31st March 2021. So, you should never forget the fact that MPL applies SLFRS for SME, and you need to have that book with you at the exam. It is one of the permitted publications to be taken to the exam hall. Now, the first one, under the first one, 3 items have been given, so you need to provide accounting treatment. So, they want us to explain the action verb is important, explain the accounting treatment to be used, right. Now, this is MPL. MPL seems to be the acquiree, but you need not to look at it from the consolidation viewpoint. Why? The examiner has been very clear on the requirement. Accordingly, MPL expects to recognize the following adjustments in its financial statements. It's not that Are we supposed to give the accounting treatment on the acquisition date in the consolidated financial statements? No, that's not the requirement, that's not the expectations, and you need to give the accounting treatment, explain the accounting treatment in the individual financial statements of the acquiree. So those points are very important in answering. Sometimes you will be depressed at the exam, in the examination environment, and you will not read the questions properly, and you will panic, and in a rush you will decide, okay, the examiner is asking us to give the accounting treatment on the acquisition date in the consolidations. You are losing whole mark. So understanding the question is very important. So you need to pay attention, and you need to tie up your mind with the text of the question. So let your mind to absorb each and every single word and to realize what examiner really expects from you all guys. So a provision for guarantee by MPL to a bank for obtaining a loan by another party. It happens. Now say the other company will think of a company, say XPLC or X Limited, whatever it is. X is a company which has applied for a bank loan from their own banks, and the banks would have been little reluctant or backward in granting the loan because their creditworthiness would have been questionable. Now MPL has volunteered to issue a guarantee to the bank of this particular company, maybe because MPL is a trustworthy company, creditworthy company, they are not blacklisted, and their historical records are indicative of the fact that how honest they were, how punctual or how good they have been in settling their debts. So now they have clear track records with the banks, and the banks would have accepted the guarantee, and on that guarantee only the bank of this particular company would have released the loan to this particular company. Now we know, as far as M company is concerned, it seems to be kind of a contingent liability. And for the moment, say, let's say that can be a contingent liability, because whether MPL becomes liable to settle the loan of this other company or not depends on how good the other company who took the loan will be, how good it will be in settling the loan. And if this other company who obtained the loan will not be as good as their words, as usual they have defaulted, of course the problems will be falling on the lap of, on the shoulders of MPL, and they will fall into prey, and they will get into a trap, and they will become liable to pay the bank loan of this company to the bank of this particular company. But now the text of the question reads and says that by 31st March 2020, that particular company has completely settled the loan, no arrears, no default, no outstanding, and on top of that, above all, the company who obtained the loan seems to be financially held, and even if there is some amount of outstanding balance of the loan, this particular company does not seem to have any financial difficulties of not being able to settle that amount. So what it says is, now it is very clear and obvious that MPL is very unlikely of falling into a trap of being caught to someone else's liabilities, and it's not going to be a liability anymore for MPL, and it's not going to be a provision either. Why? For there to be a provision or a liability, you need to have a present obligation arising from a past event, and that event has not occurred. So what should be the event that triggers the liability for company MPL? The event would have been defaultment of the loan by this particular company. So this company has not defaulted. That event has not occurred. And what is the chance of that event occurring now? Even the chance is very remote, because the loan has been settled in full, and even if they haven't still settled, settling that loan will not be a big issue for that particular company, but they are financially healthy, they are financially strong, and there is no probability of a cash flow flowing out from company MPL to settle the outstanding loan of this particular company, because there is no outstanding balance. And the best estimate, you need not to estimate anything, because there is nothing to be estimated. So, as per case 37, the requirements that are needed to be satisfied, the requirements to be satisfied to recognize a provision are not satisfied. So, there are no, there is no requirement to look at those criteria even. Why? Because this particular company has completely settled the loan, and MPL will not have to pay anything to settle that loans of this particular company. So, LCase 37 has been very clear. You need not to recognize any liabilities, any provisions on that debt, because the required criteria you can evaluate, and those criteria are not satisfied to recognize a provision or a liability. So, now it says a provision for guarantee given by MPL to a bank for obtaining a loan by another party, and the acquirer has considered it as a liability. So, that being considered to be a liability is completely wrong. Why? You need to explain it in terms of LCase 37. You need to give that criteria. What are the criteria? There has to be a present obligation arising from a past event, and that present obligation does not exist, and a past event triggering liability has not occurred. So, the outstanding balance is 0. Outstanding balance is 0. If the outstanding balance is 0, there is no probability of outflowing resources of MPL for a settlement of a loan. Best estimate, there is nothing to be estimated about. As a result, that acquiring company has decided to recognize a 10 million liability on that guarantee, which is absolutely wrong. So, you need not to recognize any provisions or any liability. Why? The requirements to recognize provisions and liabilities are not satisfied. So, let me go through for you the suggested solution given by CS Sri Lanka. I have mentioned that LCase 37, anyway that is a technical mistake, and you cannot indicate LCase 37 because this is an entity for which SLFRS for SME applies. So, you need to go to the relevant section of provisions and contingent assets and contingent liabilities, SLFRS for SME. You can find it out. That is section 21, page number 151 in my book. And once again, you know, if you read the section of, if you read that section, provisions and contingencies, section 21 of SLFRS SME, that is exactly similar to LCase 37, but you cannot indicate LCase 37 in your answer because we have not adopted full SLFRSs, we have adopted only SLFRS for SME, but the contents of the answer should be the same, there is no difference. So, according to para 21.4, 21.4 of SLFRS for SMEs, an entity should recognize the provisions only when here the requirements have been given. They have been taken from section 21 of SLFRS for SME. The entity has an obligation at the reporting date as a result of a past event. It is probable that the entity will be required to transfer economic benefits in settlement, and the amount of the obligation can be estimated reliably. Para 21 1.12 states that contingent liability is either a possible obligation, is either a possible but uncertain obligations, or a present obligation that is not recognized because it fails to meet one or both of the conditions B and C in paragraph 21.4. An entity should not recognize a contingent liability as a liability except for provisions for contingent liabilities of an acquiree in a business combination. In this case, the party has properly serviced the loan so far and has a healthy financial position, so MPL does not have a present obligation to pay the bank as at 31st March 2021. Further, MPL is the acquiree in the said business combinations, therefore MPL should not recognize a provision. So this is a contingent liability as it is possible but uncertain obligation, so therefore MPL should disclose the guarantee given as a contingent liability. There is not even a contingent, according to my personal view, there is not even a contingent liability. Why? If the loan has fully been settled, there is no chance of even it being a contingent liability. But anyway, that is what the examiner, the suggested solutions of CS Sri Lanka says, the same contents, but the way of presenting can be little different. So you need to talk about it by giving the criteria of section 21, the required criteria to be satisfied in recognizing a provision. So I hope it was clear, so we can move on. Here we go. Next one, a fair value gain from property, plant and equipment amounting to 170 million rupees and the deferred tax impact thereon amounting to 40 million rupees. Right. A fair value gain from property, plant and equipment amounting to 170 million. And the deferred tax impact thereon amounting to 40 million. Right. Now, if it is in consolidated financial statements, of course, there is no problem. You can recognize it as per the relevant section of SLFRS for SME. But now the examiner says these adjustments are proposed to be incorporated into the individual financial statements of this is MPL. And you cannot revalue just because the parent company or the acquirer decides to revalue. You cannot revalue property, plant and equipment unless it is your accounting policy. So you need to see whether the revaluations of property, plant and equipment is what you have adopted as the accounting policy for subsequent measurement of property, plant and equipment. If it is the accounting policy, so there is nothing wrong, absolutely there is nothing wrong in revaluing property, plant and equipment and recognizing that revaluation gain into equity, and at the same time the correspondent deferred tax element you recognize on that revaluation gain should also be recognized into OCI, other comprehensive income. And that is what you need to say. It's completely dependent on whether the entity MPL has adopted the revaluation model of LK 16 for subsequent measurement of property, plant and equipment. So let me also read out the suggested solution given by CS Sri Lanka for this part. Recognition of fair value gain from property, plant and equipment depends on the accounting policy of MPL of PPE. if the accounting policy is to use the cost model, MPL cannot recognize fair value gains. However, if MPL uses revaluation model, fair value gain from PPE can be recognized only for the classes that are measured at revalued amount by recognizing the gain in other comprehensive income. Alternatively, MPL may change its accounting policy from cost model to revaluation model, in which case fair value gain can be recognized. Deferred tax liability relevant for the recognized revaluation gain should also be recognized in other comprehensive income. So, the examiner has gone on to say that they can also change the accounting policy, that is based on LKS 8, and then to recognize the revaluation gain to OCI along with the correspondent deferred tax element of revaluation gain. Next part of the question, number 3, part Roman simple number 1, an internally generated brand that has a fair value of 30 million. So, let us go to the relevant section of SLFRS for SME. Let's see the relevant section, intangible assets. Intangible assets other than goodwill, this is section 18, 126 page number. Internally generated intangible assets, paragraph number 18, point 14. Now, it says an internally generated brand that has a fair value of 30 million rupees, the brand is considered to have an indefinite useful lifetime. Now, brand that are arising right within the business organizations are not permitted to be recognized as intangible assets. Paragraph number 18.15 says, as examples of applying the preceding paragraph, an entity shall recognize expenditure on the following items as an expense and shall not recognize such expenditure as intangible assets: internally generated brands, logos, publishing titles, customer lists, and items similar in substance. See, the standard has been very clear on that. You need to recognize intangibles only if the paragraph number 18.4 says the criteria for recognition. It says an entity shall apply the recognition criteria. Okay, what are the recognition criteria? It is probable that the expected future economic benefits that are attributable to the asset will flow to the entity. The cost or value of the asset can be measured reliably, and the asset does not result from expenditure incurred internally on an intangible asset. So, those are the recognition criteria of internally generate or recognition criteria of intangible assets under SLFRS for SME. Now, you can recognize intangibles only if those requirements and the criteria are satisfied. Having said that, specifically paragraph number 18.14 says that items like expenditure incurred on items like internally generated brands cannot be recognized as intangible assets. So, as a result, you need to expense it immediately to the profit and loss without it being recognized as intangibles in the financial statement. So that is the answer. Also you need to support the requirement, you need to support your answer with the requirement quotations of recognition criteria from the relevant section of SLFRS for SME, and then also you need to mention the fact that paragraph number 18.14 explicitly excludes and does not permit 18.15 paragraph explicitly does not permit internally generated brands to be recognized as intangible. So what should be the accounting treatment? Accounting treatment is to expense it immediate to the profit and loss without it being recognized as an intangible asset. Hope it was clear. Now let me read out the question of the examiner. As per paragraph 8.4, it has to be 18, I think. Oh yes, an entity shall recognize an intangible asset if and only if it is probable that the expected future economic benefits that are attributable to the asset will flow to the entity. The cost or value of the asset can be measured reliably, and the asset does not result from expenditure incurred internally on an intangible item. Since the brand is an internally generated asset, MPL cannot recognize it as an intangible asset. So that has been what the examiner has given in their suggested solutions, right. So we are moving to Roman simple number 2 of question number 2. During the year, MPL issued preference shares amounting to 50 million rupees in redeemable 50 million rupees redeemable after 5 years. According to the agreement entered into with the holder of these preference shares, the holder has the right to require MPL to redeem such shares after 3 years at the price mentioned in the agreement. The accountant is not sure about the accounting treatment to be adopted for these preference shares, right. Now if you watch the videos of webinars of CA Sri Lanka on financial instruments, so this part has been very clear there, and we have discussed how preference shares should be presented in the financial statements, and LKS 32 devotes and assigns couple of paragraphs to explain how and where the preference share should be presented, and that is based on the substance, and that substance will be determined based on how the capital will be repaid and how the dividends will be repaid. Now the examiner does not talk anything about the dividend payment pattern, and the examiner speaks only about the capital repay. That's more than enough for us to come to a conclusion. Now you recognize something under equity only if the entity has an unconditional right to avoid the payment. You heard me right. An entity can recognize something under equity only if the entity has an unconditional right to avoid payments. Now the simplest available example that anybody can ever think at the spur of the moment. If you have equity share capital, you have no right to repay them. You have no obligation rather to repay them. And you have an unconditional right to avoid the payment. And however much the shareholders will convince you to repay, you can remain calm and quiet and still you need not to pay. And however much the shareholders will insist persistently to repay the capital of equity shareholders, you can stay still and remain silent and calm, and you need not to worry about it. Let the shareholders do whatever they want, and the shareholders of ordinary shares will threaten you that they will jump up to the highest point in the world and jump off and commit suicide, and they will sometimes threaten you holding a bottle of poisons and rolling on the ground of the company saying that, look here, they will threaten you to repay the capital, if not they are going to commit suicide. Still you can remain quiet and calm, and still why? You have this unconditional right to avoid the payment, no contractual promise obligations whatsoever to repay the capital of ordinary shares. But even if you promise to pay capital on conditions, after 3 years, after 5 years, if that happens, if this happens, if those conditions are satisfied, still on conditions you become liable to pay. There are conditional obligations. So for that to be, for something to be equity, please make sure you must have this unconditional right to avoid the payment, and then only you recognize something under equity. Here you have given the right to the shareholders to make a request to redeem the shares in after 3 years. After 3 years. So that is now in the simplest language. Now if you forget about the technicality, now this is a very simple area. It's like you walking into a bank and applying for a bank loan and promise to repay the loan in 3 years time, after 3 years, and you would have been given a grace term like 3 years. Let it to be share capital, let it to be preference shares, let it to be ordinary, and let it to be equity, let the name to be any damn thing. You will never decide on the name, and it has to be purely based on the substance. What is it like? You are issuing preference shares and the investors have invested in your preference share capital, and you have given them a promise to redeem and repay them after 3 years. So what is it similar to? It is like you having applied for a bank loan and to repay the loan in after 3 years time. So irrespective of the name given, irrespective of the terms and the terminology used, you need to look at it and decide it based on the substance. What is the substance? That is like you having taken a loan. So since you have this obligation to settle, it has to be a financial liability. So how should you word it? You need to go to the relevant section of SLFRS for SME and you can find it. Liabilities and equity, there is a separate section for liability and equity, you can find it. That is section 22. How will you word it in the question? You need to say that an item can be recognized under equity only if the entity has unconditional right to avoid the payment. This entity has given the right to the shareholders to request or require MPL to redeem the capital after 3 years time. So it has to be a financial liability. Why MPL does not have that unconditional right to hold on to the payment, to avoid the payment, and this has to be measured at amortized cost. If you are very precise in your answer, let's see the examiner's answer. As per paragraph 22.3, unless an entity has an unconditional right to avoid delivering cash or another financial asset to settle a contractual obligation, the obligation meets the definition of a financial liability and is classified as such. Para 22.5, a preference share that provides for mandatory redemption by the issuer for a fixed or determinable amount at a fixed or determinable future date, or gives the holder the right to require the issuer to redeem the instrument at or after a particular date for fixed or determinable amount, is a financial liability. So the examiner seems to have used the entire explanations from the SLFRS for SME. Accordingly, MPL should recognize these preference shares which give the holder a right to require MPL to redeem such shares after 3 years at a specified price as a financial liability and should be measured at amortized cost. And that's the end of our discussion of question number 2.